The IRS officially confirmed on February 27th, 2026, that every American age 65 or older may be eligible to claim an extra $6,000 deduction on their federal tax return. And this deduction is available right now through 2028, which means you have 4 full tax years to use it. But here's what concerns me deeply. The majority of seniors who qualify for this deduction are either not claiming it at all or are not aware it exists because it was quietly tucked into legislation without any major public announcement. If you are 65 or older and you filed your 2025 tax return without this deduction, you may have already overpaid the IRS and you can still get that money back. Hit that subscribe button right now because this channel covers every IRS and Social Security update that affects your retirement money every single week. And stay with me because I am going to walk you through every single thing you need to know to claim every dollar of this deduction before the deadline arrives. Effective for tax years 2025 through 2028. Individuals who are age 65 and older may claim an additional deduction of $6,000. And this new deduction is in addition to the current additional standard deduction for seniors under existing law, with the $6,000 senior deduction being per eligible individual, meaning $12,000 total for a married couple where both spouses qualify. This is confirmed directly by the IRS on their official website, and it is not a proposal, it is not pending. It is current law right now, affecting every eligible senior who files a federal tax return. Let me make sure you fully understand what this deduction actually is before we go any further, because the confusion around it is costing real seniors real money right now. For tax year 2026, there are 2 different federal deduction rules that can benefit seniors. The long-standing extra standard deduction for age 65 or older, and a separate temporary enhanced senior deduction of up to $6,000 per qualifying person. Most seniors know about the first one, the existing additional standard deduction that has been available for years. What most seniors do not know about is the second one, the brand new $6,000 enhanced senior deduction that was created by the One Big Beautiful Bill Act, signed into law on July 4th, 2025. These are 2 completely separate and stackable deductions. You do not have to choose between them, you claim both. And together they represent one of the most significant reductions in federal tax burden for seniors that has been available in many years. For the 2026 tax year, the basic standard deduction is $60,100 for single filers and $32,200 for married filing jointly. On top of that, the regular age-based extra standard deduction is $2,050 for an unmarried senior and $1,650 per qualifying spouse on a joint return. The newer $6,000 senior deduction is available for 2025 through 2028. Under current law applies per eligible individual and can be claimed whether you take the standard deduction or itemize. Put all of that together for a single filer aged 65 or older who qualifies for the full enhanced deduction, and you are looking at a total potential deduction of $24,150 against your taxable income. The $1,600 basic standard deduction, plus the $2,050 age-based additional deduction, plus the $6,000 new enhanced senior deduction. For a married couple where both spouses are 65 or older, the total reaches $40,900 in combined deductions. $32,200 base plus $3,300 in age-based additions, plus $12,000 in the new enhanced senior deduction. These are not small numbers. For seniors living on Social Security pension income and modest investment returns, these deductions can eliminate federal income tax entirely or reduce it to a fraction of what it would otherwise be. Now, let me walk through exactly who qualifies, because this is where many seniors make mistakes or incorrectly assume they do not qualify. Effective 2025 through 2028, individuals age 65 and older may claim an additional $6,000 deduction, and it applies per eligible individual or $12,000 for a married couple if both spouses qualify with the deduction, phasing out for taxpayers with modified adjusted gross income over $75,000 and $150,000 for joint filers. There are 4 specific requirements you must meet. First, you must be 65 years old or older by December 31st of the tax year you are claiming the deduction for. For your 2025 tax return, that means you must have turned 65 on or before December 31st, 2025. For your 2026 tax return, you must turn 65 on or before December 31st, 2026. Second, you must have a valid Social Security number that is valid for employment and was issued before the due date of your tax return, including any extensions. Third, if you are married, you must file jointly. The married filing separately status does not qualify for this deduction. And fourth, your modified adjusted gross income must fall within the qualifying range. This deduction phases out above a certain income level, with a modified adjusted gross income of $75,000 for singles and $150,000 for those married. Filing jointly, and it phases out completely for MAGI above $175,000 and $250,000 respectively. This means the deduction does not disappear the moment your income crosses $75,000. It gradually reduces between $75,000 and $175,000 for single filers. If your income is between those two thresholds, you still receive a partial deduction, just not the full $6,000. Only if your income exceeds $175,000 as a single filer or $250,000 as a joint filer does the deduction phase out completely. The majority of seniors receiving Social Security as their primary income source fall well below these thresholds and qualify for the full $6,000. Here is something critically important that most seniors and even many tax preparers do not fully understand about how this deduction interacts with your Social Security income. One of the most significant tax burdens on retirees is the federal taxation of Social Security benefits. Up to 85% of your Social Security benefits can be subject to federal income tax if your combined income, which is your adjusted gross income plus non-taxable interest plus 50% of your annual Social Security benefits, exceeds $34,000 for single filers or $44,000 for married couples filing jointly. The new $6,000 enhanced senior deduction reduces your adjusted gross income, which is one of the three components of the combined income calculation. A lower adjusted gross income means a lower combined income number, which means fewer seniors crossing the thresholds where Social Security becomes taxable. For seniors whose combined income was previously sitting just above the 85% taxability threshold, this deduction may bring them below it, not just saving them $720 in direct tax from the deduction itself, but also eliminating or reducing taxes on their Social Security income entirely. The compound effect for some seniors can be worth thousands of dollars per year, far more than the face value of the $6,000 deduction alone. This deduction is available for both itemizing and non-itemizing taxpayers, meaning you do not have to choose between this deduction and your standard deduction. This is one of the most misunderstood aspects of the enhanced senior deduction. Many seniors assume that because they already take the standard deduction, they cannot claim additional deductions on top of it. That is not how this works. The $6,000 enhanced senior deduction is claimed on a separate form. The IRS created Schedule 1A Form 1040. Additional deductions beginning with the 2025 return where the senior deduction is computed in Part 5, then carried to Part 6, and the total goes to Form 1040 or 1040 SR line 13B. You take your standard deduction the same way you always have, and then you claim the $6,000 in addition on Schedule 1A. They are completely separate calculations that together reduce your total taxable income. When you prepare your return, you will indicate your date of birth, and if you are 65 or older, the IRS will automatically calculate your eligibility. And a good tax preparation software program will flag your eligibility automatically and apply the deduction for you. If you use TurboTax, H&R Block, Free Tax USA, or any major tax software, your age triggers the eligibility check automatically, and the software should apply the deduction without you having to manually locate it. However, if you prepare a paper return, you must specifically check the age box and include accurate Social Security numbers for all qualifying individuals on the return. If you work with a tax preparer, you should specifically ask them whether they have applied the new $6,000 enhanced senior deduction to your return. Because given how recently this legislation was passed, not every preparer is proactively flagging it for every eligible client. Now, here's the part that may apply to you right now today. If you already filed your 2025 tax return and you are 65 or older, and your income is below the $75,000 threshold as a single filer, or $150,000 as a joint filer, and your preparer did not claim the $6,000 deduction, you have overpaid the IRS. With TurboTax, you can make changes to your 2025 tax return online through October 31st, 2028, and TurboTax Expert Full Service will amend your 2025 tax return through November 15th, 2026. The official IRS process for correcting a filed return is Form 1040-X, the amended return form. Filing an amended return to claim a missed deduction is completely routine, has no negative consequences, and can result in a refund of the taxes you overpaid. The IRS typically processes amended returns within 16 weeks. If you believe you missed this deduction on your 2025 return, filing an amendment sooner rather than later gets your refund to you faster. Let me give you the complete real dollar picture of what this deduction means across different senior scenarios, so you can see exactly what it is worth for your situation. A single senior with $30,000 in Social Security income and $15,000 in IRA distributions, total income of $45,000, who qualifies for the full $6,000 deduction, saves approximately $720 in federal taxes at the 12% bracket. A married couple both age 65 or older with combined income of $60,000 from Social Security and pension, who claim the full $12,000, saves approximately $1,640 in federal taxes. And for seniors whose income is close to the Social Security taxability thresholds, the compounding effect of reduced combined income can save several hundred additional dollars on top of those direct savings. A single filer age 65 or older with 2026 adjusted gross income of $62,000, who takes the standard deduction and qualifies for the full enhanced senior deduction, could see total potential deductions reaching $24,150. The new bonus deduction applies regardless of whether you itemize or take the standard deduction, so it could help those with sufficient deductible expenses to itemize, but who also want to further reduce their taxable income. This means even seniors who itemize their deductions, those who have significant mortgage interest, charitable contributions, or medical expenses, can still claim this $6,000 on top of their itemized deductions. It truly is additive in every scenario. There is one important warning I need to give you directly. Because this deduction has received significant attention, scammers are already using it to target seniors. You may receive phone calls, emails, or text messages claiming that the IRS needs you to verify your personal information or pay a processing fee to receive your $6,000 senior tax benefit. This is fraud. This deduction is claimed on your tax return. It requires no separate application. It requires no phone call to the IRS. It requires no fee of any kind. If you receive any communication claiming to offer you your $6,000 deduction in exchange for personal information or payment, hang up immediately and call the IRS directly at 1-800-829-1040 or visit irs.gov to verify anything you are unsure about. Here is your complete action plan. If you have not yet filed your 2025 tax return, file immediately and make sure the $6,000 enhanced senior deduction is included on Schedule 1A if you are 65 or older, and your income is below $75,000 as a single filer, or $150,000 as a married joint filer. If you already filed your 2025 return and this deduction was not claimed, file an amended return using Form 1040-X to recover the taxes you overpaid. If you use tax software, verify that the deduction appears in your return before submitting. If you work with a tax preparer, ask them directly whether Schedule 1A has been included and whether the $6,000 enhanced senior deduction has been applied. If your spouse is also 65 or older, confirm that the full $12,000 combined deduction has been claimed. And for the 2026 tax year, the return you will file in early 2027, understand that this deduction continues, and the income thresholds remain the same, so plan your income accordingly to stay within the qualifying range. The senior deduction is available for the 2025 through 2028 tax years, but then it expires under current law. This means you have a defined window, 4 tax years, to maximize this benefit. After 2028, unless Congress acts to extend it, this deduction disappears entirely. Planning your retirement income and tax strategy around this 4-year window is smart and can save you thousands of dollars between now and when it expires. You paid taxes your entire working life. You contributed to the system for decades. This deduction exists specifically because Congress recognized that seniors on fixed incomes deserve meaningful tax relief in retirement. Every dollar of it belongs to you. Make sure you are claiming it. Subscribe to this channel so you never miss another IRS update or Social Security change that affects your retirement income. And share this video with every senior you know who is 65 or older. Because right now, thousands of eligible seniors are leaving $6,000 on the table simply because nobody told them it was there.